hope that you've already found this video series useful in terms of beginning to understand yourself a little bit better and giving you some ideas as to how you're going to create a successful trading future with the right mindset for trading, and also some tools for mastering the emotional and the psychological side of trading. We've discussed how beliefs are important in trading and how to build the right beliefs about yourself as a trader. And we're going to take this a step further now and look at how beliefs about markets form, how the market manipulates beliefs, and how you can use this knowledge to make money. Essentially, we form beliefs about the direction that the market is going to go in by looking at charts, by listening to the news, or sometimes we just get a feeling, don't we? And we assume the belief that the market is either going to go up or it's going to go down. Once assumed, we become a bull or a bear, and we think in terms of bullish thoughts or bearish thoughts. Once we've become a bull in our mind, our brains seek evidence that would confirm to us that the market is going to go up. Once we become a bear, the same happens, only we see the market just through the eyes of a bear trader. And we tend to ignore signals that would indicate the opposite, because we want to be right. We need to remain objective, though, in trading to see the truth, and I'm going to give you some tools to help you with that later in this series. 90% of the time, both bulls and bears are able to make money in the market as long as they manage their trades correctly. 100% of the time, we can lose money in trading by managing our trades poorly and by taking impulse trades based on incorrect assumptions. So, how do beliefs about the direction that the market is going to go in form? Well, they form by us watching the market and forming assumptions, and also through our knowledge. Have a look at any price chart on your favourite market. And, well, have a look at this one here. The price action is littered with spikes, isn't it? I'm talking about the spikes on the end of the candlesticks on the chart. At one stage, each of these spikes was a solid candlestick. And pay particular attention to the ones at the top and the bottom of price swings. When the candlesticks at the top were full candles, they would have been green. And there'd have been green candlesticks reaching up to the sky. What sort of beliefs do you think that this would have created in the mind of some traders? They may have been thinking that the market looked like it could only go up, right? What about the spikes at the bottom of price swings? Well, when the candlesticks at the bottom were full candles, they would have been red. Red candlesticks reaching down to the ground. And what sort of beliefs do you think that this would have created in the mind of some traders? Well, they may have been thinking that the market looked like it could only go down. It's true, isn't it? And this is how the market manipulates beliefs. Traders who bought and sold at the extremes here lost money, and they lost money because they were duped into adopting a false belief. As a beginner trader, we see big green bull candles and we think that the market's going to go up. We see a big red bearish candle sticking out the bottom of a support level and we think that the market's going to go down. Once we've formed a belief about the market direction, we tend to become oblivious to the other side of possibility. We see the market through the perception of the bulls or the perception of the bears. Let's assume then that we see the market approaching a key resistance area, and we watch as the market approaches. Is it slowing down? We say to ourselves, and the market ticks back a little bit. Is it turning? We say to ourselves, and the market starts moving down a bit. It is turning. I was right. I'm going to get in before I start losing out. And the market resumes its move upwards. It's still moving up very slowly. That's a sign that it's going to turn, we say to ourselves. and the market pulls back again slightly to the resistance level. And we say, I'm staying in my trade, it's going to go down. We say this to ourselves, don't we? And then the market powers on upwards and takes out our stop. And we think, what happened there? Well, once in our trade, we only saw the action through the eyes of a committed bear trader. We missed the obvious. The market was going up. The market broke out of resistance, pulled back, and then confirmed the breakout. We need to remain objective in trades and as we watch the market action. We need to remain objective and open. We need to remain objective to both bull and bear points of view as we sit on the sidelines considering trades. We need to take trades with a positive mathematical equation, and we need to understand that trading's about judging probability, not about being right. So here's an example about how beliefs form in the market and how they can influence us. So let's have a look at this chart. This is the pre-market action on the FTSE 100 index chart. So imagine we're sitting down at our computers and we're watching the pre-market price action. And we can see that the market's going up and it's in a bull trend on our chart. We begin to suspect as we watch the action that the market will open up strongly. And therefore, in our minds, we become a bull. We check a higher time frame and the market's currently in the upper third of a trading range. We flip back to our shorter time frame chart and we notice the market's still going up. So the market opens and price ticks up. We think, well, it's definitely going to go up. And at this stage, this is now a belief that we have. We have suspicion and initial evidence. We wait for confirmation and we get a big green candlestick and we say, I am right, the price is going up. And this is when the belief's confirmed. And we get ready to trade and we say to ourselves, if price goes above the high of this candle when the next candle opens, then I'm going to trade long. And price continues upwards on the next candle. And we sit there in our trade convinced that price is going up. What we've failed to remember, or what we've unconsciously ignored, is that price is in a long-term trading range and we're now at the top of the range. We've been blinded to the bear side of probability by our 100% belief that the market is going up. Anyway, price immediately starts reversing and ticking down. And we're now in a losing trade. It's a temporary blip. It will go up, we say. Price pauses. And just as we begin to suspect that we may have been wrong, it starts going up again. And we get our hopes up. It doesn't go up far enough for us to get out break even, but far enough for us to resume our belief that the market is actually going to go up. We then sit in our chair convinced that the market will go in the direction of our belief, until we're shaken out of our trance by the market stopping us out, or our losses becoming so huge that we can't stand the pain any longer. So here's the order in which beliefs are formed. We have a suspicion or an initial suspicion, or we come to a logical conclusion based on past history or on current events. And then we get some more evidence, and this confirms our suspicion. We then get confirmation evidence, and there's the belief. So let's have a look at the same events on the market, but take the bear point of view to these events. And we'll imagine that we're in the head of a pro trader. So our pro trader sees price going up pre-market, and he takes a look on a higher time frame and he sees that price is approaching the top of a trading range. And he knows that the probability is that when price is in a trading range, it'll stay in the trading range rather than break out. He's prepared to keep an open mind, but his inclination is to take sell trades from the top of the range if the market gives specific reversal signals. He sees price rise as the market opens. This is no surprise to him. And he says to himself, well, there are only amateurs buying here, and nobody's selling yet. because they know that they can sell from a higher price in a few minutes' time, probably. Price will actually reach the upper level of the trading range, more than likely, and then we'll see the big players enter short. And this is what a pro trader thinks to himself. And he knows that the probability is 80-20 in the favour of price staying within a trading range rather than breaking out. He knows that the other bigger market players also know this. He sees price pause at the upper level of the range and he waits. Price starts falling and he gets the reversal signal that he was waiting for. This is his confirmation that the trade has a good probability of completing successfully, and it's a good trader's equation, and he takes his trade short. At this stage, to the untrained eye, it looks highly unlikely that the market will fall. However, all is not as it seems in the markets. The thing with markets is that price action only takes account of actual trades completed and ignores traders' intention to trade. It ignores the intention of traders watching on the sidelines and the intentions of current market participants. As the pro trader watches his trade, he sees prices rise temporarily and he says to himself, that's okay. Prices often test the previous high before falling. He isn't believing what he's seeing. He's believing in his system, his knowledge, and in the laws of probability. He knows that he'll probably make money on the trade, and he knows that he may not, and that's okay with him. He waits to find out. Either way, he stood by his system, and therefore he will be right, even if he isn't successful on this one trade. And this is how pro traders think and behave.